Now, a minute ago, when we were talking about the cash flow statement, I alluded to the idea that the cash flow statement broke apart a business's cash activities into three general categories. And so this is kind of a little graphic of how the three categories are related. Now, operating activities are the things that you and I see as customers of a business or as employees of a business, right? We see what goes on in a day-to-day level of a company. A company, let's say a merchandising company, a retail operation, they buy their stock and they sell their stock and they pay their employees. Or if it's a manufacturing company, they buy their raw materials, they put people to work building their products, and they sell their products, move them around to other warehouses, etc. So these are all the operating activities of a business. Those are the things that we would see. But in order to obtain the money to purchase the assets, or to just get their hands on what's called working capital, a company needs to engage in financing activity, right? And financing activities are those activities that entail acquiring cash to either invest in assets, or to sort of pay for the lag in time between when a company sells and when they get the money. That's called working capital shortfall. Okay. So financing activities have to do with either taking on loans from banks or paying back loans, or taking on ownership shares by issuing stock, or by paying owners through the distribution of dividends, or in the case of a sole proprietorship, owners are paid by doing what's called a withdrawal. Okay, so those are financing activities. They have to do with how a company acquires cash to pay for either its operations or for its investments. And now investing activities are sort of the flip side of financing activities. Investing activities involve purchasing, not necessarily inventory that you're going to turn around and sell, but investing in things like large assets, buying a truck, buying a building, those kinds of investments. Okay, so these are the three activities that businesses engage in on a day-to-day level and that are recorded within the statement of cash flows. Okay, so now here are some sort of definitions of some of the financing activities that have to do with taking on debt that need to be repaid, right? So one of the challenging things about accounting for students is that a lot of these words that we use in accounting are sort of general purpose words that mean something very specific in the world of accounting. So liabilities are a debt that it needs to be repaid at some point, okay? So there are lots of different kinds of liabilities, and taking on liabilities is considered part of a financing activity. So one major source of liabilities are accounts payable, which are monies that a business owes to its suppliers that are going to need to be paid pretty soon. Okay. Bonds are a type of debt that a business takes on. It's beyond the scope of this class to go into a lot of detail about different types of bonds. But bonds are sort of structured debt that are used to purchase large-scale capital investments. And so the bonds payable are these bonds that are going to need to be repaid. And then interest that's due is called interest payable. So again, when you see the word payable, that means you're going to need to pay it. It's a liability. A note payable is another kind of a debt instrument. So you take a note from a bank to make a purchase. Okay, so A note payable implies that the payment is an amount is borrowed plus interest, and notes are issued on a short-term or a long-term basis by the banks, or sometimes by the entity that is going to sell you an asset. You'll hear the phrase sometimes, take back a note. So I wanted to buy a business from somebody else, and the owner took back a note. That means that you owe liability to the person that you purchased the business from. Okay. Now, the other major kind of financing activity is not actually a liability, but it's a financing activity that does not imply that the liability is going to be repaid. Okay. So ownership shares do not imply that you are going to ever repay that money to the owners. They become part owners of the business. And so shares of ownership are sold to generate cash, and those are sold in the form of shares of stock. And stock includes common stock, right? So common stock would be, a particular kind of stock that most of us are more familiar with, and it just sort of sells the bearer of the stock interest in the company, ownership interest in the company. Okay, capital. Now, capital is another one of those words that you see in general usage, but that means something fairly specific in the world of accounting, and it refers to the large-scale investments that are made to either start a company or grow a company. So capital improvement projects would include building a new building on a college campus, right? Capital investment is a whole sort of subfield of finance having to do with how you come up with the cash to do these major projects. Okay, so a capital investment in our world means that the owners of a company invest some capital in a company to sort of start it up, and eventually they expect to gain some sort of return over their original investment, right? Another way that you can acquire cash to pay for capital improvements is by borrowing. Right? So capital implies large-scale spend, and you can gain the cash for large-scale spends of money through either investment by owners. That's also like the Shark Tank kind of thing. Like, you ever see that? You hear about venture capitalists, right? Venture capitalists invest in startup companies in the hope of gaining significant returns when the company is sold, right? Or companies can take a more measured approach and acquire cash through borrowing from banks with the expectation that that capital will be paid back with interest. Now, investing activities are those activities which get assets for you. Okay, so companies invest in assets, and there are two broad categories of assets: tangible assets, which are things that you can touch and feel, and intangible assets, which are assets of a company that don't have any physical presence. For instance, what is the most valuable thing that Coca-Cola owns? Right? It's the recipe for Coke. Nobody knows what that is. It's a trade secret. It's an intangible asset, but it has a significant value to Coca-Cola. It is an asset for sure. But tangible assets are those things that we are normally more familiar with, things like, vehicles, trucks, buildings, ovens in a bakery, cash registers, those kinds of things, right? The assets that we see and can touch and feel that have physical characteristics. Now, an important category of assets are things that you have paid for that you will eventually kind of use up. So if you're starting up a business and you prepaid your rent for 6 months, at the beginning of that 6-month period, all that prepaid rent is considered to be an asset, because you're going to get value out of that rent that you prepaid that you don't have to pay next month because you already paid it over the course of the time that you've prepaid it for. And then there's a procedure in accounting called accrual, which allows you to recognize these expenses when they actually are used up. And we'll get into that later. Again, this is just sort of a definitional piece of the class right now. Now, accounts receivable are another kind of asset. It's a short-term asset. And that what that means is that you've sold something, but you haven't gotten the money for it yet. It's been bought on account. So you're waiting to get your money from your customer. And these are a very important category of asset that need to be really paid attention to, because sometimes you can have a lot of sales, but if you haven't gotten the cash for the sales yet, you run into a cash flow problem, right? So receivables are funds that you expect to get from your customers. It's the right to a payment from customers who purchase merchandise or service on credit. Okay, so again, this is just sort of a definitional slide, just vocabulary words here. Now, we talked about financing activities. We talked about investing activities. Now we can talk about operating activities. These are 3 uses of cash in a business. Operating activities are revenues and expenses. These are the items that show up on your income statement. Okay, revenues come, they come from sales of merchandise. They can come from fees earned by a service company. And you'll see in the income statements that we look at during the course of this class, you'll see revenue called by different names. But the important thing to know is that revenue is the monies that a company earns through the provision of its goods and services. Okay, and then expenses are the costs associated with generating that revenue. So it's important to keep in mind that expenses do not include all of the costs that a company takes on. Some of the costs that a company takes on have to do with the purchase of capital equipment. So if you have a landscape company and you buy a truck, okay, the money that you spent on that truck is not an expense of the business at that time. Okay, you have to expense the truck over a period of time that is supposed to be roughly comparable to the amount of time that the truck is going to live. But expenses that are directly associated with the earning of revenue, such as your cost of goods sold, right? How much it costs you to actually manufacture or acquire or pay for your subcontractors to generate the revenue that you actually earned. And other categories of expenses would include selling expenses. So the cost of your marketing, the cost of your Facebook ads, the cost of getting your products out to the world. Those are all selling expenses. And then administrative expenses, your overhead, the cost of your senior management, the cost of running your copiers, the cost of your rent, certain kinds of rent. Okay, so these are all the expenses, and they have to be matched to when the revenue was earned. So the matching principle is very important in accounting, this idea that you have to try to figure out how much a particular sale item actually cost. So again, we're going to stop this here. This was just a lot of definitions, a lot of concepts. We're going to have another concept check and then move on to the next mini lecture.